into all of the code sections and the different things that can happen. But the tax planning of a merger or an acquisition is probably, it's one of the most critical pieces of it, because it helps determine, besides the purchase price, how much money you're going to put in your pocket if you're selling the company, and what it's costing you and what kind of benefits you're going to get if you're acquiring the company. So in its basic fundamental form, right, you have a buyer that wants to buy some company, and you have a seller that wants to sell the company. And there are a number of ways that it can be done, and a number, stock sales, asset sales, merges of stock for stock, and variations on all those different things. So it actually is very critical. The unfortunate part about it is, and I've been through this a lot of times, is they bring the tax guy in at the very last minute. So that the deal's been ironed out, it's been hammered out, and then and I just wanted to let you know how it really works. I mean, the first thing I do is somebody comes in and says, we have this acquisition, or we're acquiring a company, or we're selling a company. What do you think of this? And I'm presented with all these facts, which towards the end of the deal, it's already been ironed out. And then the next thing you know, somebody's screaming, "Who's this Nelson guy? He's screwing up the whole deal." And that's, and really, I mean, so just to know the process that I go through, I mean, the first thing I look at is, does it work, tax-wise? Am I keeping anybody out of trouble? Is there a possibility it can be challenged? If I'm representing the seller, how much taxes am I, how am I going to pay? If I'm representing the buyer, what am I going to, how much money am I going to get out of it? What are the taxes going to cost me? I look at the effect on my client, but I also look at the effect on the other guy, because whatever happens to me is bad for the other guy. So if it's good for me, it's bad for him. If it's good for him, it's bad for me. So I have to look at both sides of the equation, because it becomes a talking point, a negotiating point. So it's very important that I understand, first of all, what the transaction is, and then it's a question of what is the effect of that transaction. And then the third thing I do is I try to figure out, is there a better way to do it? Well, is there a better way to do it for my client? And if there is, what is that way? And then how do I tell the other person, the other side of the party, what the effects is to them and why why they should do this. So I think it's critical to know that. And then the last thing I do is I look at is what happens after the deal. So for example, on the first part of this, we got involved in a company where it was owned by an ESOP, and they were going to acquire another company, and they were going to use ESOP stock to acquire the other company. Not a client of ours. We were hired to just look at the transaction. The deal was supposed to be consummated in another week. Legally, they could do it. Tax-wise, they could do it. But then there's rules out there called ERISA that deal with pension plans, and an ESOP is a pension plan. And we looked at the ESOP rules, and we called up and we said we have some concerns about 4 things, and one of them was prohibited transactions, and a couple others, and I don't remember the 4 of them, but it's irrelevant what they are. But basically, everybody said, "Oh, don't worry about it. It's not a big deal. It's okay." Well, we got an ERISA attorney involved, and the risk was way too great. Yeah, you could do it, but the risk was more than what anybody wanted to live with. The risk meaning that the plan would be disqualified, and so the whole deal within the course of a week had to change. Now they negotiated a cash price. The price was different than what the stock was supposed to be, so it just ended up with having to renegotiate the deal. As far as something happening after the transaction, we had an S corporation that sold its assets, a large gain in the S corporation, and getting through all the tax of that. The problem was that if the shareholder wanted to keep the money in this S corporation because he had control over what happened to the money. He had family members involved. And we said to him, if you don't close this thing out by the end of the year, your capital stock tax, Pennsylvania capital stock tax, is going to be $300,000+ a year. So we ended up at the last week in December setting up an LLC. He transferred all the assets out of the S corporation, got the family members to sign off on it, but saved $300,000 a year. So it's critical to get the tax people involved. The earlier the better. It saves you a lot of time. Like I said, a lot of times we get called in at the very end of it. So, when you get involved in one of these things, the sellers and the buyers obviously have conflicting interests. Most sellers want capital gains because that's taxed at a lower rate, 20% going forward, maybe 23.8%, as opposed to ordinary income, which next year jumps up to this year jumps up to 39.5%. So how do we get there? I have, sorry. So we got to look at the tax goals of the various parties, and we have to look at all of the different ways that the transaction could be structured. And so really what I wanted to do is I'll jump forward to the next slide, which will help me go through all of this. So you have different entities. You have C Corps, S corporations, partnerships, and limited liability companies. So what I thought I would do is just kind of go through a few things that happen on each of these. So in a stock versus asset sale, for example, on a C corporation, if I sell the stock of the C corporation, if I'm the selling shareholder, I get all capital gain. If I'm the purchaser, I get no benefit of that at all. I bought stock, I have basis in the stock. I don't get any write-offs for assets, I don't get any write-offs for goodwill. If it's an asset sale in a C corporation, if I'm the seller, I'm going to have gain in my corporation, so there's going to be, whatever the gain is, it's just going to be taxed as a regular gain at the corporate rates. There is no capital gain distinction in a corporation. And then when I try to get the proceeds out, I'm going to pay tax again. That's the double tax of a C corporation. So now I pay a second tax on the liquidation. Not a great deal for either side. You know, obviously one side benefits from the other, right? If I'm the seller and I sell the stock, then that's great for me because I have all capital gain, but the buyer gets no benefit. If I sell the assets, I'm the seller, I get a big tax burden, and the buyer now gets to write off his assets, you know, his fixed assets over 5, 7, or whatever number of years, and goodwill, which is a write-off of over 15 years. So I get a bunch of tax benefits. If I'm an S corporation and I sell the stock, it's the same thing. If I'm the seller, I get capital gain. I get to reduce it by my basis, but it's all capital gain. If I'm the buyer, I just have basis in the stock. I don't get any step up in any of my assets. And it's the same, but the difference between an S Corp and a C Corp is I'll report the gain on the S Corp return. It'll pass through to the individual shareholders, and then it increases their basis for that piece that they pick up in income. So the relative gain on the further liquidation is usually nominal, because I get to pick it up on my individual return through the S Corp. So it's really only one level of tax. So that's the real benefit of having the S Corporation. Partnerships are a completely different animal. Whether I sell the assets of the partnership or whether I sell the partnership interest, the tax effect is pretty much the same. If I'm the seller, I get capital gain, but to the extent that I have something called hot assets are treated as ordinary income. And what are they? If I'm a cash basis taxpayer and I have unrealized receivables, all of a sudden that has to be picked up as part of my gain will be recharacterized as ordinary income. If I have appreciated inventory, it's picked up as ordinary income. So that's something that has to be looked at. If I'm the buyer, I do get a step up in assets. There's a section called 754. It's a common, that's what people call it, a 754 election. That'll allow me to step up my purchase price, step up the basis in my assets, and obtain some depreciation deductions for it. So there's a benefit to both parties in that, except that the one party will have you know, ordinary income for a piece of it. Limited liability companies, I don't know if anybody knows much about limited liability companies from the standpoint that you can have a limited liability company that's a C corporation, it can be an S corporation, it can be a partnership, it can be a sole proprietorship. So it can be a whole bunch of different animals. And the way that it's taxed depends on what it is for tax purposes. So if I'm a single member LLC, meaning that one person owns it or one company owns it, it's treated as a disregarded entity. Well, that means that it doesn't exist for tax purposes. So basically, if a corporation owns it, it's a division. It's considered a division of the company. If an individual owns it, then it becomes a Schedule C item, a self-employed business. But I can elect to make an LLC an S corporation. And from my understanding, the reason that people do that is that it's entirely for legal purposes. If you're under the corporate rules and the S Corp rules, there's a whole bunch of things you're supposed to do, corporate minutes and formalities that have to be followed in order for it to qualify as a corporation for the state and to help protect you if there's a problem. With an LLC, you don't have those same qualifications. You don't have those same responsibilities that a corporation has. So the paperwork and the record keeping is a lot less, but you get the tax benefits of being an S corporation. Same thing, you can elect to be a C corporation, and if you make no elections, like I said before, if you have one owner, it's a disregarded entity. If you have more than one owner, it automatically becomes a partnership and then falls under the partnership rules, unless, of course, you make an election to be a C corporation or an S corporation. So a lot of people aren't familiar with that, and a lot of times people get into trouble with, well, I have an LLC. Like, I have an LLC, it's treated as a partnership. You say, okay, well, I'm selling my membership interest in my LLC, which is like stock, which is true. So therefore, I should have all capital gain. And I turn around and say, well, wait a minute, you know, you're a cash basis taxpayer. You have all these unrealized receivables. You know, you're going to pick up 40% of that because that's your share as ordinary income. So 40% of whatever you get of your gain is going to be ordinary and not capital. So you have to be careful with LLCs and what you're selling. And if you're a disregarded entity, it doesn't matter. It's treated, if you're selling a disregarded entity, it's treated as if you sold all of the underlying assets. It's like it's treated like an asset sale.